Welcome to our fourth quarter video update. It is my great honor and pleasure to once again welcome Glenn Murray, Chief Investment Officer and President of Capstone Asset Management. And of course, joining me as well is my colleague and fellow portfolio manager, Maria Dawes. Hi, guys.
Hey, Janet.
So, Glenn, you're a busy guy, so let's get right into our first question. Since our last update, we've now approved two vaccines by Health Canada, so that's very positive news. I don't think that we're out of the woods just yet. What sort of impact, if any, do you see this having on the Canadian economy? And what are some of the challenges you still see ahead?
Thanks, Janet. I think the 2021 Canadian economy could be viewed as a tug of war between the short term headwinds caused by the COVID's resurgence and lockdowns versus the long term tailwind from the rollout of the vaccine and the subsequent economic recovery. Without a doubt, the vaccine will have a positive impact on the economy as it will allow for the broad reopening of business and for Canadians to begin to normalize life towards whatever the new normal will be. The quicker this can take place, the better economically. So, the more vaccines that can be approved, the quicker an economic recovery can occur. However, in the short term, the economy is going to continue to face similar headwinds to those of 2020 as we undergo continued lockdowns and restrictions. I believe we are better equipped to deal with these compared to where we were in the spring of 2020. But from an economic perspective, it does mean that the first two, maybe three quarters in 2021, we can expect continued challenges and weakened economic activity overall until restrictions are reduced and the vaccine rollout takes effect in the broader population. Although the vaccine will help get us to the starting of an economic recovery, the success of that recovery will very much hinge on the responses to the environment in which we find ourselves. Unfortunately, Canada will likely find itself in an economic hole from which we need to climb out. That's one that's been created by unprecedented debt spending, the level of unemployment, marketplace disruption, and more recently, even the strengthening of the Canadian dollar. To begin with, how we act coming out of the pandemic will dictate what the recovery looks like. Will we re engage with travel? What will we spend money on? What changes to lifestyle will emerge? As an example, we know that the government stimulus spending increased personal income level during the pandemic, and we saw some of this excess move towards savings. Will people now begin to spend some of that savings, and how will they choose to spend it? These types of decisions are just examples of what will impact the strength and form of economic recovery we experience. However, one of the key factors that will support the recovery is a central bank's ongoing accommodative position. With our central bank seeing the recovery lasting into 2023, we can expect there will be very limited pressure to increase rates. Additionally, they have indicated the first move would be a reduction of the 4 billion a week of quantitative easing they are currently conducting in the bond market versus an interest rate increase. With this continuation of interest rate policy and quantitative easing, the Canadian economy will continue to have access to cheap capital and liquidity. Obviously, this comes with its own set of problems, but it will help the recovery in the short term. So, there are still a lot of unknowns for sure. But once the vaccine has been broadly distributed, it is fair to say that once we get there, the short to midterm environment will be accommodative to growth overall.
Thanks, Glenn. So, given we also have investments not only within Canada, but could you give us some brief thoughts on the US and the global economy as well?
That's probably a big question for a short time that we have. But I think it's fair to say that the US and global economy, like Canada, will be reliant upon the successful rollout of the vaccine. We do expect some global economic recovery in 2021 with positive economic growth from an overall global perspective. This will likely be varied, though, as the vaccine rollout and subsequent opening of the economy will look different country to country. with many countries potentially not seeing this rollout occur fully until into 2022 or even beyond. However, the US appears to have good access to vaccines and is more reliant upon the success of their distribution. Currently, they have over 5% of their population vaccinated, but have only used roughly 50% of their delivered doses. So once the delivery is sorted, then they will be well positioned to get the vaccine broadly distributed. Additionally, there is likely to be further stimulus come as Biden pushes his $1.9 trillion package, while the Fed has continued to indicate they will leave rates unchanged for up to 3 years, and Biden's initial appointments have been more centrist in position, which all will be more accommodative and for the market particularly. So I believe that the US economy is likely in the best position for economic growth in 2021.
Thanks, Glenn. We'll be talking a little bit about stocks shortly, but I'm curious to know what you see happening in the bond market. We previously were in a situation with limited liquidity, which has been skewing spreads. So, what can we expect going into 2021? Are we in a lower for longer environment? Will there be continued volatility in corporate spreads? Your thoughts?
Yeah, if we look at the current bond markets, there is not a lot of return to be gained simply in the rates that are available, particularly in government bonds. The significant amount of negative real returns on bonds globally makes them not overly appealing, especially with the potential risk of capital loss. Additionally, the involvement of central banks in purchasing bonds has had and will continue to have an influence on the market. Currently in Canada, as mentioned earlier, that represents 4 billion of bonds being purchased each week. This participation it's also known as quantitative easing, starts to limit the availability of product on the market. As quantitative easing then spreads more broadly into other parts of the market, like corporate bonds, it influences the market risk profile as it becomes a built-in buyer, which can result in compressing the credit spread between corporate and government bonds, which really is the excess corporate yield over the government yield. Finally, I do not see an immediate risk of inflation in the market. This is due to factors like the rise in the Canadian dollar, likely delay in economic recovery during the vaccine rollout, unemployment levels, just to name a few. With the central bank continuing to hold steady on rates and its bond buying, I expect interest rate environment will remain low for some time. However, the corporate investment grade spreads compressed significantly last year after it had a dramatic increase at the outset of the pandemic. This spread could compress a little more and may be an area of opportunity for some performance gains, but likely not significant. These are the reasons that we continue to recommend including private debt within a bond portfolio to provide some enhancement with lower correlation to traditional markets. This can reduce some of the portfolio risk while improving the consistency of the performance.
Thank you, Glenn. So we spoke already about this briefly in our last quarterly update, but again, I have to bring it up because our traditional equity pool has done very well this year, not only relative to its past performance, but relative to all of our funds. And I believe beating out both the TSX and the S&P on an absolute return basis and on a risk adjusted basis. Any further insights into why we were able to have such a strong year despite being in such volatile times?
Yeah, you're correct. We did discuss this in the last call, but I'm happy to give a brief update. It was a great year for the fund. It delivered a very strong performance with our I-Class series returning 23.52%. Versus the TSX, which did 5.6%, and the S&P 500, which did 16.32. Importantly, we also provided a Sharpe ratio, which is the measure of risk-adjusted return of 1.48, and that compares favorably against the TSX at 0.21 and S&P 500 at 0.8. So this means that not only did we provide an overall better performance in 2020, but that we also took less risk for our clients to achieve that. These results for 2020 are really a continuation of the strategy changes that we made in the last quarter of 2018. Those changes were centered around the move to make the strategy more global in focus versus a more domestic bias that had existed until that point, but also to allow a broader implementation of strategies into the portfolio. On the last call, I did discuss the changes we made at the beginning of the pandemic, but for those who may not have heard that call, we did remove a little of the excess risk by reallocating our capitalization mix, which refers to large, small, mid-cap size stocks, along with some adjustments to the global asset holdings. The result of this was an allocation that was approximately one third in each of Canada, US, and the global markets, along with a more even distribution of our capitalization mix. During the fourth quarter, we didn't make any tangible adjustments to the portfolio as our convictions really remained the same. However, the results for the fourth quarter were particularly strong as our I series had a 16.25% return versus the TSX at just under 9% and the S&P 500 at just under 7. So the key contributions in this last quarter continue to be from our Asian market investments, and they do continue to perform well. And also we had a particularly strong performance from our North American holdings, which includes exposure to information technology, as well as a special situation strategy we work with.
Glenn, we also won an award this year for our non-traditional equity pool. And in fact, this is the second consecutive year that we've won this award. Can you tell us about that and what it means to Capstone?
Yeah, I'm happy to, as we see it as an endorsement of our overall approach to the pools we manage. Currently, our non-traditional equity pool is the only strategy we have that qualifies for one of the Canadian Hedge Fund Awards. It competes as a multi-strategy fund in the category of Global Macro Managed Futures Multi-Strategy. The fund was awarded first place in 2019 and then again in 2020 for the best 5-year Sharpe ratio. So this award category recognizes the fund that has provided the highest risk-adjusted return. This is particularly meaningful for Capstone as our desire is to provide clients an experience that is less volatile while still providing consistent returns over the long term. Since launching this fund over 6 years ago, it has performed in line with the TSX returns, but provided a risk-adjusted return of 2.4 versus 0.3 for the TSX, meaning we are rewarding our clients with more performance for the level of risk we take for them.
So, Glenn, 2020 has seen with it a housing trend towards detached housing in BC. And we also saw the Toronto Regional Real Estate Board reporting home sales reached a record level for the month of December, an increase of 64.5% on a year-on-year basis. And home sales were up 8.4% in 2020, which is the third best result on record. When we have things such as record low interest rates, a move towards single-family housing in tandem with it being a pandemic year, with many families struggling financially. How does this all fit together from a macro perspective? And does the macro perspective matter at the end of the day? I know that's a lot of questions in one.
Yeah, it was. I do think the macro and also the micro perspectives do matter and do ultimately play out in the real estate market. So let's consider some of the potential factors from 2020. To start, I'm not sure that the families struggling financially were evenly distributed across the broad job market, but rather it likely hit those in the lower income bracket disproportionately. This would typically mean a greater impact on the rental market versus the home buyers one. There was a trend of people moving out of main cities prior to the pandemic due to the search for affordability and lifestyle change. But the pandemic definitely accentuated this trend in 2020. With the remote working and the lack of opportunity to get outside, the pandemic added additional reasons for many already considering the idea. Further to this, immigration typically would provide an offset to that. But in 2020, we saw restrictions coming in regarding immigration due to the pandemic. And finally, as we discussed a few times, we saw the government intervene aggressively with pandemic stimulus plan. The result of this was a significant increase to disposable income in 2020, which provided individuals with some financial flexibility. So, when we consider all those together, with a significant stimulus provided by a low interest rate environment, then you have a strong platform for the real estate market growth that we witnessed this last year. As we enter 2021, low interest rates should continue to be a positive stimulus to the market. We will monitor here the ongoing employment levels, immigration policy, continuation of the 2020 trends, and the general economic recovery to better understand how the market will play out throughout 2021.
So we're at the beginning of a new year, 2021, and we're hoping it'll be better than 2020. Glenn, can you give us some things to look forward to in the upcoming year? What is the investment management team working on?
Definitely. Key area we're excited about, but are still trying to understand the best way to implement, is the further integration of our values into the impact investing space. With Capstone's experience in non-traditional investments, we believe there are great opportunities to invest in our current strategies or through new funds where we can leverage that experience, our values, and our resources to see a greater impact made through those investments. An example of this is the research we have been doing concerning investing in renewable energy projects through financing their construction in East Africa. This is an investment where we see great opportunity to provide investors a good return while also able to make a positive impact to both the environment and the local community in the area. Beyond that, we are looking forward to seeing how some of the new investments we introduced into our pools in the last quarter of the year begin to perform throughout 2021. For example, we invested in a couple of private equity strategies through our non-traditional equity pool by repositioning some of the excess cash we carried during the year. And in our high income pool, we re-entered the market after putting investments on hold until the third quarter due to COVID. We were able to add an exposure to a basket of private debt positions in the corporate mid-market, as well as further investments in private real estate debt. Finally, a few of the commitments we made in 2019 that were on hold due to COVID in 2020 are now being called. Overall, there is still uncertainty around COVID and the timing of the vaccine, but we're excited about some of the opportunities that the market is presenting.
Thank you, Glenn, so much for your time once again. I always find your insights to be very valuable, and I'm sure our clients do as well. So thank you, and bye for now. Maria, until next time.
Yeah, until next time. In our next update, we will continue along with our theme of financial planning, given that we're into tax season and we're open to topic suggestions. So if this is something that you're interested in, let us know. And thank you so much for joining us. If you'd like to find out more about any of the opportunities that we spoke about today, please be in touch with us by phone or email. Bye for now.
Bye.